All right, one of my favorite topics is business entities, and I want to dive into that one as it relates to tax and all things, really. This is something we spend a lot of time talking about with our clients, and it's one of those areas where some people have some strong views, and it's also one of those areas where if they're not up on it, they're down on it. I imagine you've dealt with this a million times, and especially from the IRS standpoint. Any words of wisdom that you could share with folks?
Boy, I look at it more from the tax perspective than the asset protection perspective, from my background. But obviously, the two are so intimately related as far as, why do I want to set up a business entity? Why do I want to set, why do I need a corporation or an LLC when all I'm doing there is paying legal fees and I'm paying the state of Nevada or California or Colorado, some filing fees, and I got to keep paying this every year, and I got to do all these books and records. Why do I need all that stuff? Why don't I just, get some insurance and just call it good? And I've had a lot of different people say that to me over time. And, where do you even start with a question like that or a comment like that?
I remember vividly, I think it was in 1999. LLCs were not recognized in all jurisdictions yet, right? Like the IRS didn't know how to treat them yet. We didn't really have the disregarded treatment, I believe, back then. And we were in the habit of telling people, isolate your liability, especially on the commercial side. And so this was a commercial building, and the accountant for the individual said, oh no, you don't need an LLC, you just need insurance. And I wrote back to the person, email was just a thing.
Yeah, probably, yeah.
And I wrote back saying, have them accept liability then. If they don't think it's a big deal, have them indemnify you if there's ever liability that does not get covered by insurance or exceeds insurance. And of course the accountant wouldn't do it. And I said, why not? If it's not a big deal, it's because it is a huge deal, right? And back then, again, these things were a little less utilized. They weren't as well known. Now they're every day, and nobody would ever think about having a commercial building in their name. But I still remember that. I still remember that letter. I remember the wonderful accountant declining it, and it's because it's not just about tax. It's about the operations. It's about business planning, whether you're going to raise money, whether you're going to get credit for it. It's about isolating the liability from the business and you. It's about isolating you from the business. It's about being able to create a legacy. And all of these things are impacted by that decision as to what type of entity you actually choose to operate as.
Yeah, it's real important. A lot of times when I'm looking at setting up entities or I'm advising somebody on that, I'll ask them, well, what do you plan on doing with this business? How long do you plan on having it? And how do you want to end it? And I'll get this look like, what do you mean end the business? I'm just here to set it up. I'm getting ready to start it. I'm not thinking about ending it. But what I want to look at is, a potential lifespan of the business so that, you're 25 years old, you come in, you want to start a business, you may plan on operating that for 50 years or something. So I'm not necessarily as concerned what you want to do at the end, but there's big differences as to the different entities and how you operate the business day to day, and then also what happens when you want to get out. What are your options? What are your tax hits going to be if, let's say, you want to sell your pizza business or whatever to somebody else?
And this is true in all things, is knowing your exit before your entry. And that goes whether it's stock trading, real estate, entering a business, doing anything. You really do want to know what your exit is when you're walking in. And with the business entity, it can make this big of a difference. Let's say that Scott and I talking to the same client goes into Scott, and Scott is one of those practitioners that says just be a sole proprietor. And it's easy, right? 70% of the businesses out there just are no entity, or they're an entity that's disregarded straight through the owner, and it goes on a Schedule C on their 1040. And then that same person comes up to somebody like me who says, well, hold on for a second, what are you actually setting up? Why? What do you plan to do with it? And they set up a software business. Let's just say it's software business. And 10 years later, that software business is worth $2 million. Well, the individual where they just set it up as a sole proprietor, that entire business is going to end up being taxable when they sell it, versus somebody like me who may set them up slightly differently, may avoid the tax entirely on that $2 million. And we're not talking about a small amount. If it's a couple $1,000,000, the minimum amount of federal taxes is 23.8% on that transaction. With the sole proprietor, they're looking at probably substantially more, because there's going to be a lot of things that are ordinary income there, which could be as high as 37%, depending on what year they're recognizing it. So there's a huge difference. There was about a $600,000-$700,000 difference there, potential difference between those two transactions, simply because of the way it's set up. But without getting too confusing, let's break this down a little bit easier. Let's talk about risk first. So I am going to do a business, and I need to know what's the worst thing that could happen when I enter into that business.
Right. The first, one of the first questions I'm going to ask my client is, what can you do wrong? What can go wrong here? Who can sue you? And I don't care what kind of a business you have, there is some possibility of being sued. You have litigation risk, lawsuit risk, and you may think, oh, it's really, really minor, but you still have it. Up to, some business where, every day that they go into work, it's a huge risk, for just by the nature of the work itself.
Surgeons it's like a 20%, like certain categories, they have a very high likelihood of creating litigation around their activity.
Right.
But it could be as simple as like, hey, I'm a plumber, right? And I go into somebody's home, and my accountant says, oh, hey, let's keep this real simple, just be a sole proprietor. And you don't realize, hey, I go into somebody's home and I forget to seal a pipe. And as a result, after I do all my work and after everything's put away, that pipe disconnects in the wall, and I have a massive flood event that occurs in a house, and it does $1.5 million worth of damage. Why am I bringing this up? Because it actually happened, and I can say that plumber is now looking at personal exposure on that. They're, but I have insurance. Not to those levels, you typically don't, or they may not cover you under all instances. Like there's exclusions for a reason. They may be getting out of it. What you want to be able to do is put a box around it and say, worst thing that could happen is I lose my business. I don't need that thing following me around until I pass away with somebody trying to take my money.
Right. I mean, let's look at that situation. Just take it just one step a little bit further here. So the client came into me. I don't know anything about these entities. Don't know what I'm doing. I say, let's just take the easy road on the sole proprietor. Let's forget about the selling of it on the back end and whatever. Forget that. But let's just look at the liability. So I'm this plumber, and I have this problem here, and I'm a sole proprietor versus I'm a corporation versus I'm an LLC. What would be the difference, I guess, to me as the plumber? I cause $1 million worth of damage because I flood out this house that has all these records in it. I do all these damages. I'm a sole proprietor now. Guess what's exposed? Everything.
My home.
Everything. Right?
Any retirement accounts. A lot of people think that they're completely protected. No, it depends on the type of account. It depends on your state.
Yep.
Anything that I make in the future. If I'm married in a community property state, probably anything that my spouse makes in the future. Like we could all be on the hook for a liability that doesn't go away. And I can just tell you as an attorney that in a past life, when I first started, I did some litigation on the plaintiff side, which means that we were trying to collect monies from people. I still remember one case in particular where a gal damaged a landlord's house, physically took a hammer out and smashed the walls down, over 400 holes. We litigated against her and actually avoided bankruptcy. She tried to bankrupt it away. You can't intentional acts. We garnished her for over 10 years. Every job she had. So you don't want to be in a situation where you're facing that as a business. Now, I don't have a lot of sorrow for her because she did it intentionally, but you didn't do anything intentionally. You're just trying to run your business, and you have liability. I'll give you a real life example. There was a gal, and she was in her 80s when I met her, but she had lost 15 pieces of property in litigation. And the reason that she lost it in litigation was because she had really good attorneys and accountants, according to her, but they set everything up and she owned everything in her own name. They said, just get good insurance. And she had a commercial building amongst all of her real estate. There was 15 pieces of property. Several of them were commercial, and she had a lot of duplexes, single families, things like that. But it was a commercial property that caused the issue. And what had happened was the manager had hired window washers. And the window washers had given a card that showed license and bonding numbers, and they didn't verify the licensing and bond, which I don't think is necessarily unreasonable. If somebody says, here's my licensing and here's my bonding, and you're paying them a couple $100 to clean some windows, you're probably not betting them out super hard. You're just excited you found somebody who's willing to climb up there and clean windows. 2 electrocutions took place as a result of these two window washers, and they both lost their life tragically. But what ensued afterward was the insurance company denying coverage because the license had lapsed. So they said, we only cover licensed and bonded contractors, and it was your failure, and we're not going to cover. And she ended up losing that building in a foreclosure. Then they moved to another piece of property, and another piece of property, and another piece of property, all 15, including her home. She was allowed to keep a portion of the home under homestead and under bankruptcy. But for the most part, she lost her entire fortune because she simply didn't isolate that liability. So if we had asked that question, if she'd walked into my office today, I would say, what's the worst thing that could happen on each piece of property? What are you willing to lose? We would have had that property in an LLC more than likely, and probably isolated by itself. You know, not everybody does a single entity per property. It depends on the value of the property and your other holdings. But let's just say at a minimum, we would have isolated at least 20% of her estate from itself. So, you know, maybe it was 7 LLCs instead of none, right? You don't necessarily need to go 15, but we would have probably had something there that wouldn't have been 0, that's for sure. Right. And now, worst thing that would have happened was she would have lost that one property if she had had it isolated properly. And it's just sad to see that hold itself true over and over and over again.
Well, yeah, and especially for somebody like that who doesn't have the time to make the money back up, you know. And, you know, you look at somebody like that and, you know, I don't want 15 LLCs. Well, that's fine. Let's set up 5 LLCs and put 3 properties in each one. We can certainly do that. Now you have a problem in one of the LLCs. You're going to lose potentially all 3 of those properties, but your other dozen properties are safe.
Yep.
And I think, you know, if we go back to the insurance example too, with the plumber here, you know, my poor advice there, right? No, don't worry about an entity, just do a sole proprietorship. And I say, just get insurance. So my plumber goes out and gets $1 million worth of let's say some sort of a commercial liability policy, maybe a commercial umbrella policy to be on top of the other policies that he may have. But so what? The lawsuit here is 1.5 million. And so now the insurance covers $1 million, and now I've got a $500,000 that just wiped me out or took away a lot of my assets. So, you know, I think there, when you're looking at it, you've got to look at the box. You've got to look and say, okay, what can I do with this plumber, or with these 15 rental properties, or with the pizza place, or whatever it happens to be? What can I do to make sure that the very worst day that this business is ever going to have, when everything goes wrong and then some, is going to be contained in the box, and it's not going to go outside of the walls of the box and start taking away my personal assets. So that it could be a tragedy from a business standpoint, right? I could lose my business, I could have to bankrupt it or whatever, but it's not taking away my retirement plan, my account at Schwab. It doesn't take away, you know, anything that my spouse maybe has or whatever. So I think you have to look at, what's my exposure here? What am I willing to risk? You know, how much of it am I willing to risk? And what I'm not willing to risk, how do I protect it? How do I cover it with some insurance? And then also, what's my box? You know, what's my LLC? What's my corporation? What's my C or S? How am I going to get an entity in place that's going to make that terrible day at work not get any worse?
And I would flip it around a little bit too and say, you also have terrible days at home. Like, we've seen this over and over again. Somebody has a teenage child, and that teenage child causes a catastrophic accident that exceeds the insurance limits, and now they're looking for everything mom and dad owns. And sometimes it's a case where it's not even catastrophic, but they're alleging it is because they realize mom and dad have a bunch of assets and there's nothing blocking. Is you want to isolate the business from the individual as much as you want to isolate the individual from that business in many cases. But there's a few things that I wanted to touch on of what you just said, not the least of which is insurance, because a lot of people say, hey, I go to an asset protection attorney, I don't need insurance. That's not true. Your insurance is still your first line of defense, and there's different types of insurance. There's typical liability policies, there's policies for business, there's policies for an individual, there's umbrella policies that should be commercial in nature for the business first, and then they cover you. That's what I would do. I wouldn't just do an individual policy that doesn't cover your business, because you're not getting the full benefit out of those dollars. You need to be covered in the event someone pins their ears back and comes after you. You want to make sure that at least the attorneys are covered, right? Whatever it's going to cost to defend yourself. Because especially if you find yourself on the backside of a frivolous suit, or somebody who's trying to take advantage of you and allege massive amounts of damages, think of an employee case, or whenever I say what's the worst thing that could happen, let's say that you're a doctor and you decide you're going to buy some rental properties, and you buy a low value rental property in the Midwest because it's great cash flow, and you buy it in your name, and you're like, oh, it's not a big deal. And then a tenant realizes you're a doctor, right? And now they're alleging mold, and they want $1 million. And your insurance company is like, hey, we don't cover environmental issues and this, that, and that. And all of a sudden, your worst day at work is this dang piece of property is going to cost me $200,000 to defend myself, and my lawyers basically say give them $100,000, right? More than the value of the property. You'd have been much better off just isolating that property on its own. So that worst case scenario is I lose that property, and chances are you never see that case, because if you do it right with, again, asset protection attorney, they're not going to be able to find you, and they're not going to know that you're a doctor. They're not going to know these things that cause them to want to come after you in the first place. You're inviting the lawsuit when you have a bunch of assets in your name, and we wouldn't allow that to occur. But I just want to say on that insurance, make sure that you have the right type of policy. If you're an Airbnb or VRBO, that's different than just being a homeowner or a landlord insurance. If I am doing long-term holds in another state, make sure that not only do you have the right type of coverage, but get a policy that covers all your stuff and has the right additional insurance, especially if you're using trusts or LLCs. Those things are powerful, powerful vehicles, but you want to make sure that your insurance company is aware so that they're covering those and you. Because at the end of the day, I don't want to have to deal with this stuff. I don't want to have to come out of pocket to deal with it. And I want to avoid it if possible. So those are some simple low-lying fruit things about business entities. Is how do I isolate the liability, recognize that the liability is me too. I could create liability for that business. I could buy assets that create liability, like I could buy real estate that always creates liability, or I could be operating a business, i.e. the plumbing business, that creates liability, and just isolating those from each other, so that if Scott says, if the worst day at work occurs, it's not going to disrupt your life catastrophically. Worst case scenario is I lose a portion. I'm willing to cut it off.
Right. Well, and again, that's sort of your risk mitigation, right? That, you're in business, you have, or let's say you have rental properties or something that could generate a lawsuit. Fine, that's just the nature of the beast. If you operate a vehicle, that generates probably more lawsuits than any other act in the United States.
Yep.
Whether you're driving, whether it's the plumber going to work, so they're driving in the course of business, or maybe they're just going out to dinner and get into a car accident. So you need to look at where is the potential source of the lawsuit going to come from, and how can you protect yourself, or at least minimize the damage if that really bad day happens.
And it's like this. I don't get sued for things Scott does. If Scott has his business and he does stuff, they don't sue me, because we're separate people. If I don't create separateness between my businesses, and I don't create separateness between my investments, then it's me, right? They're always looking at me. But I can create a Scott, Scott LLC, let's just call it that. And I could isolate it so that, hey, we're separate now. And you do that with this legal fiction, which is the use of entities. Now, it's not automatic. Like, hey, I can't just think it and all of a sudden it occurs. I have to do something. So I'm going to have to file something with the state, for example. And considerations you should be thinking of is not just tax, not just liability protection, but maybe I want to be thinking about my exit, maybe my estate. Maybe I want to think about business planning if I need to raise money for it, like if I'm doing a syndication versus I'm just shoestringing this thing. Those are all things I need to be thinking about. And then I need to be thinking about the feds and how I'm going to set it up from a tax standpoint. All of those things are actually independent when I'm choosing a business entity. And you'll always hear this thing, accountants love to say, oh, there's business formalities and this, that, and the other. And oh, the sole proprietor is so much easier. Or, oh, C Corp, double tax. They just repeat this mantra. And it's sometimes you're just like, oh, come on, stop with the mantra. Actually put your thinking cap on for a second. What are the benefits? What are the risks? What, like if I told you, hey, I'll pay you $10,000 a year and all you have to do is file this one return, chances are you're going to do it, right? Like you'd look at it and go, oh, $10,000 a year and all I have to do is one thing. How much does that one thing cost me? How much time? Oh, it takes you 2 hours and it might cost you $1,000. That'd be a no-brainer, right? Oh, yeah, I'll take that action all day long. Okay, that's sometimes how easy it is, but somebody will immediately say, oh, the formalities are more, oh, you have these extra requirements, so it's not worth it. Well, let me be the judge of that, please. Like, let's actually do the calculation and figure out what it is. And it's usually pretty surprising to people when we actually get down to it, how little difference there is between entities as far as documentation, and how big a difference there is when it comes to something like taxation.
Yeah, and I'm always surprised about that as well too. Is somebody will come in and say, well, I just want to take the easy way out. Or I was speaking on it was a Zoom webinar a couple weeks ago, and the person that was speaking before me, this so-called tax professional, made a comment that we don't ever recommend C Corps to our clients ever, because they're the double taxation. You can't get the money out, tax in a tax advantageous way, and we just simply don't like them. I mean, maybe a 1 in a million chance where you happen to be that one guy, but we don't like them. And I'm sitting there thinking, I can't believe that, first of all, that somebody is saying this, but they're missing out on so many different tax benefits. And when you mentioned, Toby, that
we should go through a couple of them.
Yeah, I think let's look at I want to look at the C Corp for a minute and just look at some of the different provisions of capital gains and things like that, just to show how wrong this person could be. But but boy, there's you need to look at the entity selection here. Let's say I know I don't want to be a sole proprietor because it's the easy way, but I don't get any benefits. So I know I'm going to do something else. You need to look at what Toby was just mentioning, though, that not only the taxes and the asset protection, but the estate planning, the ability to raise money while you're operating. All of these things are going to come into play, and sometimes they conflict. So what may be best for you from, let's say, an estate perspective? I'm 50 years old, I'm doing my estate or whatever, and I really need this S Corp. But for taxes, I really need a C Corp. So you may have a conflict there that says, well, for one, this entity is better, and for another, this entity is better, and you're going to have to pick. But in order to do that, you need to understand all of your options. And let's look at the C Corp. I mean, why was that? This guy was a CPA, so he wasn't a lawyer, but he wasn't somebody with no tax background either. This is somebody with their 4-year college. They've got their CPA. And they're coming right out on a Zoom webinar telling, there was about 300 people on the call. Of course, they don't know any of these 300 people, but they're telling these 300 people, you don't need a C Corp.
Probably depends on when they were educated, because there was a day when C Corps were pretty onerous from a tax standpoint because they were taxed at a rate of up to 39%.
Yeah.
And then we were taxed at a rate of up to 39.6% on the profit that they divvied out. That's not the case anymore. Now it's a flat 21% for the C Corp. That's the taxation of a C Corp in the U.S. It's 21% federal tax. And then when you receive that money, if they pay out the profits, you're taxed at your dividend rate, which for a lot of us is 0%. Some people it's 15, some of us is 20, depending on how much money you make. But it's definitely not as onerous as what they're suggesting. Oh, double tax is bad. But I'll tell you what they're giving up. The number one thing they're giving up is there's better deductions out of a C Corp. The C Corp gets to write off for its employees 100% of the medical, dental, vision expenses any employee has if they have a health reimbursement plan. So it could be tens of thousands of dollars a year that are going out to you. It qualifies for an accountable plan, which means you could do an administrative office for your home, which is maybe not tens of thousands, but it's thousands of dollars a year. 280A, being able to use that because you're an employee. Now you can do an arm's length transaction and rent your house to them for up to 14 days a year to have meetings. That's tax free. There's a whole bunch. If I sell the company, I could have $10 million of of tax-free gain to start. It can actually be higher. But if I set up a brand new business, let's say I shoestring it, I set it up for, you know, $100, and 10 years later it's worth $1 million and I sell it, there's no capital gains on a C Corp. There's that treatment as the sole proprietor or as an S Corp or something else could be far worse. And all of a sudden they're like, oh, you know, or, you know, let's say it's all capital gain. Let's say it is an S Corp. And something that's the CPA probably loves S Corps, right? Oh, we love the S Corp.
Absolutely we do.
Then in that case, the tax on that transaction from a federal standpoint would be probably 23.8%. So $238,000. So their wrong advice only cost their client $238,000, right? Oops. And that's just because they have a negative mindset. There's 1244 and 1202 that get triggered. Stock loss, the ability to write off the losses as ordinary under a C Corp technically has to be that C Corp proper, can't even be an LLC taxed as it. You lose so much. I'm just like,
Yeah, you just want to slap somebody at the time because you're just taking away so many things off the table that you really don't need to do. And
self-inflicted wound.
yeah, and so I think that's why, you know, again, when I'm looking at the exit strategy up front, that's real important because, you know, I mentioned before, I like to say, well, what's the worst thing that can happen? Well, let's flip that. What's the best thing that could happen? Well, you know, my company that's doing some software, some IT type stuff, we could develop this and Google could come in and buy us out. Okay, well, let's say that happens in 5 or 10 years. Well, what could they pay for it? Well, who knows, right? But, you know, a one with a whole lot of zeros after it could be coming your way. And then it makes a real big difference if you're a C Corp versus the sole proprietor guy versus the S Corp. I mean, you mentioned a couple of code sections, this, you know, 1202 and 1244. Let's look at those to see, like, what are they and how do you use them? Because if you want to be able to take advantage of some of the benefits, either losses, you know, when you're selling them, or in the better case scenario, you know, I just hit a grand slam.
Yep.
Right. And now my business that I put $100K into to start it is now worth 10 million. And now I've got a $9.9 million gain if I would sell it. So,
and it can be avoided entirely under 1202.
Right. And so how would we do that then? I mean, then I think that's where the problem comes in because if I don't tell my client, well, the C Corp has this really nice benefit on the back end when you sell it, they're going to be doing whatever, and then they sell it, make their 9.9 million and pay 3.3 million in taxes.
It really depends on what you're setting it up for and when you're having that initial conversation. And quite often they just don't know. And the old adage is if you're not up on it, you're down on it. So they're not up on C Corps. They don't know anything about them. They don't utilize them. It's not part of their practice. So I would never do one because they're down on it. They don't know the benefits of it. Because if they did, there's no way they would take the position that under no circumstances do I use them. Right. That's crazy. Yeah. There's lots of times. I have clients that have that have dependents that have tens of thousands of dollars of medical expenses in a year. And they have closely held corporations where it makes sense to have it taxed as a C Corp because the vast majority of the profit that would have been taxable is an expense that makes it not taxable. You talk about having a tax-free